Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, February 4th, 2022. S&P 500 currently sitting at 4463. I'm David Zarling. I'm here with Ian McMillan. No nickname this week. Ian, no offense.
Nothing special enough happened.
Yeah, no. We're cranking, right? We got a full day today. So we're just going to roll. And we got a closed month last month, right? January.
Yeah, just on Monday, we got monthly candles.
Yeah, but last podcast, we couldn't even talk about monthly candles, but here we are. January's done. And somewhat of I don't want to call it a historical January, but that Monday, it's why it's important to wait for the close, January 31st, definitely made a difference in the monthly candle. I think it's fair to say.
It did. It was a big day. Obviously, we've kind of rolled over since then. So I think the S&P, what did the S&P end up being down for the month? It was down 10% at one time.
Correct. It was down 10% at one time. If we look at, if we use S&P 500 cash, and I'm going to just use some round percentages rather than get too crazy with it. But for the month, it was down about 5%.
About 5%, yeah.
About 5%. I mean, you're right. It was down close to 10% at one point. Monday, January 31st, definitely helped things get back above. Now, still significant in the fact that it was a negative January. Now, I know that a pretty smart statistician out there who tracks market movements and, what takes place after that, which aren't guarantees, is Ryan Dietrich from LPL. And he, because January barometer is something that we do look at. And when Januaries are down, sometimes it can be a precursor to the rest of the year being down, or I should say lower later in the year. It may finish positive, but lower later in the year. So we'll see. He's got some good data out there. And he brought up, it's worth remembering that January is normally weak in a midterm year, which you highlighted at the Lunch and Learn. Mm-hmm. As far as a midterm election year, there's seasonal weakness that happens in January, some positivity in February and March, but then after that, it gets pretty weak going into summer. So it's worth paying attention to.
And that's what we've seen. I mean, yeah, we saw a little bit of a bounce, I guess, really Friday into the close, the 28th, and into Monday and a little bit Tuesday, but failing at some important levels. IWM has yet to get back up to even the 209. So I would say if IWM in the coming days and weeks ends up making a new low, let's say below 188, without ever getting back up into 209, 210, retesting the underside of that range, I think that would be pretty significant. And then same with S&P. I mean, got up back above the September highs. I believe that was Wednesday. And so that's a pretty big behavioral level that tells you, okay, we might truly be onto something. Maybe we're going to have yet another V bottom. All of those possibilities certainly in the air.
Yeah, absolutely.
But we've seen since then all of that kind of peter out, and we're back below. And
what's interesting is we have the other thing that is notable is when we look at where January closed, and when it closes below the low of December. So the low of December was 44.95, and we actually closed above that. But there was some really good data out there from Chris Verone that talked about when that happens. Now, we technically didn't get that. There's typically a double-digit drawdown that takes place at some point during the year. Mm-hmm. And maybe we had it. Like you said, maybe this is a V-bottom type scenario more recently, and we're seeing stocks only get accumulated from this point forward. off of that
That's
4,200.
possible. I mean, we got back above the, 200 day, which is it a rising 200 day? Yeah, for all intents and purposes. Now, has it flattened out over the last month? Sure, but nothing.
Well, are you using S&P? You're using S&P on that?
S&P.
And then on
Obviously,
the flip side,
IWM.
IWM has a fall, technically a falling 200 day with price below it. And the Qs are working. They tried to reclaim the 200 day, and it is noticeable to see the NASDAQ rejecting the 200 day, like price below it. It tried to get above it, back below it.
Well, and talk about important levels having yet been, and clearly we can go here, but you look at the Qs, never got back up to that 380 range. I mean, we got up to 370, which is
No, I think that's a great point.
That was a VWAP from the top, right? We ran into that anchored VWAP on the 12th and 13th on the way down, again on February 2nd.
And what Ian's referring to there is a volume weighted average price. And we don't need to get into the nitty gritty on that. If you guys continue to listen to the podcast, you'll hear us talk about it over and over, and we'll take time in those other segments to cover it. But Ian's point is, these are important levels from a volume weighted average price, and price reacted there. And it's a good notice that you have there, Ian, that we couldn't even get back to 380. Now, maybe we still do. I don't know.
Yeah, that's certainly still possible. I look at the October lows here again on the Qs at 350.
Yes.
So we
correct,
broke below that, then back above. Now, and this could be the start of, it's of something very, very choppy. I know that's something you and I have discussed a lot over the last 2 days are we creating some type of range that we're about to spend 2 months in similar to late 2018?
Right. Definitely possible.
We go back and forth against over these big behavioral levels. We'll see that. And it's right. And the kind of let's keep in mind, big picture here. It's been an amazing run. And are we looking at something like a 2015, 2016 on the horizon where it's not necessarily, a disgusting bear market, but then there's been bear markets in certain areas for the last 9-10 months, but a 2015, 2016 where markets, the major indices just go sideways and work off some of this, how big was the rally we had off the, from March 2020 up through these latest November, December highs, 150%. So you get a 150% rally in less than 2 years.
Right.
That's
perfectly normal.
That's perfectly normal to take some time to work some of that energy off.
Right. Exactly.
Clearly, we'd rather have it go sideways versus down. I think both are going to be very annoying and frustrating.
Well, and it's why we manage risk, because we don't know I saw another comparison, and I love it when people do this, because how our human brains are so short on memory, right? We got these memory banks. We think they're good. And maybe God allows us to keep the really important stuff in there, such as like kids' birthdays and stuff like that, and our wife's anniversary and just special moments. But we forget about 1962 and what the S&P 500 did. And it could be because that's before we were born. But 1962, very similar start to the year.
Okay.
And the full drawdown during that year was, I believe, something like 30%. And I'm not calling for that. And there wasn't even any recession. There was no recession during that period. It was just
sometimes people sell stocks.
Yes, thank you. I think that's a great quote there. Sometimes people sell stocks, or you run out of buyers. And I think that's something important to remember, that if this is the end of a bull market, it's really the absence of buyers. You've exhausted all the buyers. And that's the same thing with a bear market. It's typically exhaustion of the sellers. There's nobody else to sell. Now, I would argue that in this last period here, we've seen a fair amount of put buying. So some hedging going on. that eventually will be upside fuel. But that doesn't make it impossible for the market to continue to correct, into the summer and match the seasonality that we're seeing. Again, seasonality is not a predictor, but it's worth looking at. It's worth noting.
It is. I absolutely agree.
So we are in the thick of earnings season. I'm curious.
Ooh.
What do you
are.
What do you wear for earnings season?
My skepticism goggles.
Okay, skepticism goggles. I tend to wear, depending on the season, I might wear a sweatshirt. But I think in the middle of earnings, we get different price reactions.
I think we need to start calling it earnings reaction season.
Yes, Thank you. That would be awesome, because it's not the earnings, it's the reaction to the earnings that matter.
Yeah, and I don't even know I don't even know, I guess. I mean, the big ones people talk about, like, I couldn't tell you what was good, right? We don't listen to conference calls. We're not in there looking at like same source sales.
Mm-hmm.
I don't know, someone like guided above analyst estimates, whatever. Sell side generally is pretty horrible at any estimates or anything they come up with anyways.
Yes,
I mean, they are like, that's just like, it is what it is.
Well, and so can you walk someone through what we mean by the reaction to earnings?
Well, just what, earnings are, they give out two numbers, EPS and revenue. And then there's
earnings per share,
earnings and revenue. And then companies, they like to do guidance, and we think, oh, next quarter is going to be better or worse. Anyway,
have you ever met a CEO?
I guess sometimes these numbers are good. Sometimes they're great.
I was going to say, have you ever met a CEO who's like, I suppose sometimes they guide down, but I've never met a CEO of a publicly traded company that thinks their company's crap and guys, you should really sell our stock.
I mean, people they definitely tell you they think that like the industry's on.
We got some headwinds.
Yeah.
It's very competitive out there, yada, yada, yada. But they never tell you, hey, you should probably sell our stock.
No.
But to your point, we've seen what we call double beats, right? Beating on earnings per share.
People don't care, or they're just. I don't even know if they're double. Like, I honestly couldn't tell you like what it was, but then they sell them. Right. So I assume they're not bad. It's not like we're in a recession. Well, they're selling them, and they're important names, and
the psychology behind it is fascinating. If you catch yourself in this spot, and I'm going to describe this, fantastic earnings. Now, it might be fantastic earnings because that's what you've diagnosed it as.
Because it's better than some dude predict.
Right.
So it's only fantastics because it's better than what a bunch of people predicted. And this grouping of people is constantly wrong anyways. So I don't understand what it like. I don't know.
Well, okay. So in your mind, if you've anchored to the fact that these are amazing earnings and price does not confirm that, many are in psychological purgatory because and cognitive dissonance because they're like, why is price moving down when they had just such a great quarter? That's unbelievable. Like, why are they selling this? Well, what are markets? Future discounting mechanisms. Is it so crazy to think, holy crap, that's one of the best quarters they've ever had? Now, either A, it's going to continue, or B, that's really outside the norm. And this thing, so we got to follow price because the price reaction matters the most. What are some notable earnings reactions, let's call it in the past week?
Facebook was big to the downside.
Yeah. So we're talking about $1 trillion company.
Yeah. I mean, they gapped that through some really big behavioral levels, and they've continued. It's down 25% yesterday. It's down another 3% today. There's really nothing. I mean, I guess they can fill. Well, now they're kind of through this gap here. They filled it yesterday at 235. So Facebook knocking on the door of its February 2020 highs. We're about $7 or 3.5% away from that. Maybe.
So I want to interrupt you with your own information. You posted a really good chart, and I believe it was Facebook, about when price moves through important price levels to the left on a chart, how important and significant that is. So
yeah, I mean, we went
Facebook,
right there. There's absolutely no coincidence about where it opened up yesterday. And
well,
it's
Facebook,
wild.
it spent August 2020 through
Yeah.
March 2021,
So like
moving
8 months, 9
eight
months,
8 months of price history. Like, and that's a range, right? And that
7
typically
months
is an area where we see buyers step in on this type of correction, and it's sliced right through that.
overnight. I mean, you didn't even, it's
Like
not
butter.
like that we spent like 2 months selling through this in like market sessions.
So that's
And it was there.
tremendous information.
And then you've had some big ones like Snap. People very excited about. I guess. Congrats. Snap's not going to do much for your 401k or anything else in your portfolio unless you specifically own Snap. But there's a lot of excitement. You said a lot of excitement over Amazon.
I was going to say, can you give the math on first? Let's start with Snap and then go to Amazon. Can you give the math on Snap? Meaning, I believe when I looked at it last, it was up 50% overnight.
Yeah, it's up 45% now.
Well, and so, okay, let's just pause there. When you hear that, you're like, oh man, I'm missing out. I can't believe that. I can't believe this one stock is up 45%.
It's up 2% since Wednesday. So
I was going to say it's up 2% since Wednesday. It's down 50+% since its September 2021 highs. So let's not get carried away with ourselves.
Yeah, I mean, it's a lower high, and that's the whole thing. These lower highs that participants have used to sell into strength. And I know we've been on here for 3-4 weeks with this. I mean, if you want to call it bearish, then yeah, like let's call it bearish, skeptical, not healthy tone that we've had towards the market. And I have yet to see that behavior change. So,
right, exactly.
I mean,
but let's go to Amazon. So and the reason why I want to talk about Snap was, right, you had it 50% overnight, but still minus 50% since it's September, its highs in 2021. And so people should go out there and do the compounding math, right? It's the eighth wonder of the world. How can something be up 50% but still down 50% from September? Those in the industry are very familiar with compounding interest. But if that's not something familiar to you, you should go look up the math behind that, because it's amazing. So talk to me about Amazon, one of the biggest companies in the world, $1.4 trillion company.
I guess it had good earnings. I mean, it's up 12% today, and that's good. I mean, that's good for consumer discretionary. That's certainly a bullet point for market bulls. I mean, Amazon means a lot. Google had a good, right? So Google's going to do a 20-for-1 split. We'll talk about that kind of later on with Pratty.
Yeah, a little teaser.
He's got a kind of a special section. We're going to talk about splits. So they've sold Google since that news, I guess. I mean, not dramatically. It's above, where it was, and it's and Google above 2675, 2700 is good. Apple has yet to sell off. I mean, the things that you wouldn't, the last titans, the last bastions of health in this market have not broken down.
Right. And what are when you say the last bastions, who would those be?
I mean, well, now Apple, Microsoft.
What do you think about Microsoft?
I'm not saying Google has a pretty chart, but it's not in a downtrend.
Well, that's a big one, right? Because Pratty's going to talk a little bit about that coming up for Google as far as splits go. But when you think about another big name like Microsoft, what do you see there?
I see, I think it's got to get back above 115 or 315, which it can. I see a hard rejection into, I guess we got up to 315 on Wednesday. Which seems to be a short-term top in a lot of charts out there. We've got the September highs. I mean, 305 is a big level.
Yeah, for sure.
Right there today.
305, I would say below 283. I know that's a little bit further down, but that's where buyers had stepped up before. But 283, 284, if they're not buying it there, that goes back to that farmer's market analogy, if the buyers aren't going to be there, so it's problematic. It doesn't matter what your AAII surveys are. If there's no buyers, that's the way it is.
Big day for Bitcoin.
Yeah.
Big day for Bitcoin.
Let's talk about that.
Which is interesting. Usually more of I wouldn't say it's directly correlated to the NASDAQ, but a lot of people like to make, it's not a horrible correlation.
No, and it's not, it's not a 1-to-1, but I think it's fair to say like risk on versus risk off. That's fair. Now, I think that's going to change over time just because of how these networks work. And
it's a big move. It's a big move back into 40,000. I would say 40,000 looking out the last couple of years is a pretty big, I mean, at least last year, 2021, it was a big level. So, right, it's a 24/7 market. We'll see where we are on Monday.
Yeah, exactly. Like you said, the 40,000, 41,000 level, very important. I would say in Ethereum, same thing. The fact that it's cleared 2,800 at currently, now we're not closed yet. It needs to stick this. This is, if you want to call this a triple sow cow on the ice, not that I'm a big figure skater.
Hey, it's Winter Olympic time.
Yeah, it is Olympic time. But let's call it, what is some of the moves they're pulling off on that half pipe because I know everyone's going to be watching because Shaun White's like 72 years old.
Well, I'm sure Eli will be watching, right?
Oh, yeah.
Sure
Eli. Yeah, my oldest son is a snowboarding geek and it is awesome. And so he's going to be tuned in. It needs to stick this from an Olympic, if we're going to use an Olympic analogy.
Hey, women's snowboarding. And men's so men starts Sunday, but we got women's snowboarding all evening and tomorrow evening.
Yes, it's just amazing. Cameras always kind of hide some of this, right? As far as this, it's pretty amazing the size of these half pipes or freestyle or whatever the moves that they're making. I also love Super G and skiing, but anyway, my point being, some of these cryptos need to stick this in order to have a chance at winning the medal. And we'll see. We'll find out. Final piece.
Yeah, I mean, maybe they become more correlated to commodity. I have no idea what happens.
Yeah, maybe they turn into.
We'll see. Commodities have remained strong. I mean, oil hitting we had crude hit its highest level, $92 a barrel, highest level since 2014.
Yeah, it's a big deal. And there's lots of different, quickly go through, if you can, just some commodities that you've noticed that are.
Well, cotton remains to be pretty good. Tin.
Some base metals.
Yeah, some of those base metals. Copper still.
Yeah, that's the one.
I might be 85 years old before copper moves out of this range.
I was hoping. I was like, please let Ian bring up copper, and here we are.
Look at that. Hasn't moved in, a year.
Yeah,
has been consolidating. Now, I would assume, right, as a technician, this is a consolidation, and right, it's a year-long consolidation. It's coming off 150% rally off the, those March lows that we've talked about.
And consolidation should resolve with
resume to the upside. Yeah.
Direction of the primary trend. It is like you said, it is a massive range. It's a full year range, and it's at really important. Like when we look at copper futures.
Yeah, there's the 2011 highs here.
Yes, these are near all-time highs. So if we're moving higher in copper, it could be a couple different things, right? Because we've got treasuries breaking down, higher rates. So it definitely fits the inflation theme. So is it just purely going to be copper, or is it going to be Dr. Copper and prove to be risk on? And we're buying stocks hand over fist. Could be. I also know if they break this down, that's problematic. Copper is significant in that way that if they're going to break a year-long consolidation downwards, this kind of goes back to my small caps thing or our small caps thing. If you're going to go that long sideways and break it down, it's a little bit, it's problematic.
New highs for aluminum this week.
Aluminium. That's what you meant to say.
I did.
Yeah.
Nickel.
So nickel. Love it. So there's definitely things in the commodity space, and we own some commodities. Not bashful about saying that, not investment advice. So we've covered stocks, crypto, Olympics, earnings, you name it. Let's talk bonds. Everybody's sexiest subject. Junk bonds, high yield bonds, treasuries. What are we seeing there?
Rates
Ian?
moving. I mean, rates are, trying to move through this 2.2 level on 30 years. So obviously TLT, your most rate sensitive area, breaking lower as we would expect below that 140 level, which is kind of a important level here over the last year or so. Not a new low, but on its way to those lows, through 134 on TLT, there's not a lot left in the way until 112. So we're going to see another 20% drop in treasuries. What did we talk about? The 60-40 had its 60-40 had its worst.
One of its worst months. Yep.
Yeah.
And is it the death of the 60-40 portfolio, right? Because if they're not going to buy bonds during a correct, right? So we had a corrective market during.
We got junk bonds. Junk bonds making new lows today.
Well, and that's just it. Like, let's put it this way: your junk and your high yield, right? That operates a little bit more like equity. It's out on the risk spectrum. So those are the types of things you like seeing participate to the upside when equities are doing well. The 60-40 portfolio has had a history of being strong because the 40% that's in bonds is inversely correlated to stocks. But if we're heading into a period where we're going to sell credit, we're going to sell bonds in addition to equity, it no longer works. And so that it's an interesting time because you're talking about both high yield, which is your riskier on the credit spectrum, and treasuries, which have historically been more conservative on the risk spectrum, both getting sold. So they're selling bonds. You look at aggregate bonds and they're selling that too. So is the 60-40 portfolio.
High yield munis have absolutely been destroyed.
Oof, you're not kidding. You're not kidding. And I know we own some, but it is fascinating to see Chinese bonds hold up well.
Dude, Chinese bonds. What?
Yeah, I know.
How?
So that's that.
I don't know how.
Yeah.
I know that the chart keeps going up, so we'll continue to own them. But whatever. Maybe China's more in that environment where they're getting out of equities and getting into fixed income. Maybe it's, that theory is working over there, but not here in the US.
Yeah, exactly. So very interesting. I know, like, for example, the German bond, the German bonds, the rate has gotten above zero recently. So we're seeing
Germany.
Yeah, correct. Yeah, congrats. We're seeing higher rates. Today we're seeing treasuries break down, which means higher rates, but we're also seeing magazine covers about rates. And
yes.
So you never know as far as from a sentiment perspective where that's going to lead us. We've bumped up against the end of our time, Ian, for the client portion. We're going to have Pratty jump on with us in the extended portion to talk fintech, what we're seeing there, new payment systems versus old payment systems, and some stock splits. So we hope you guys stay on. Ian, as always, I appreciate it. Great insights, and we'll do it again next week.
Have a great weekend, everyone.
Pratty, thanks for letting me pull you on to the show here. We just had such a good conversation this week that I kind of wanted to go over with it. I thought it was worthwhile to share with those listening because you noticed some really interesting things going on with, let's label it fintech in the financial area. First of all, what is fintech, right? We've got financials, but when we're talking about fintech, what are we talking about?
Yeah, so it's great to be back on. When we're talking about fintech, I guess anything that really involves the financial services industry and the technology industry could be considered fintech. So to me personally, the two biggest names that stand out are like Square, PayPal, Visa, MasterCard.
Sure. Absolutely. Like PayPal, most people are familiar with, or maybe someone uses Venmo or something like that. Square for sure for small businesses, but just the technology that takes place within financial services. And a lot of the things you mentioned are really, I would call them payment services. So, right, we use a Visa to buy something. We use Square to complete the transaction. So, what are we seeing in that space that sticks out to you?
So what sticks out to me the most is the fact that some of these older payment processors like Visa and MasterCard are showing relative strength relative to something like PayPal and Square.
For sure. So, like you're just saying, like if we just compare something like Visa versus something like PayPal, there's definitely some opportunity cost in the newer payment system stocks, if you will. So newer would be PayPal, Square, those types. There's opportunity costs there where there might be true opportunities in things like Visa and MasterCard. Is that a fair summary?
Definitely.
Any ratio that sticks out the most? I mean, I know Visa, PayPal was one. I'm going to try to pull up versus Square here, which now is known as Block. Yeah, there's definitely that relationship too, where we're seeing your traditional payment tech outpacing, and quite dramatically. To paint the picture, if you look at PayPal and compare it to Visa, I mean, it's at the same equivalency as it was in July of 2017. So there's been no advantage in owning PayPal over Visa since mid 2017. Now that's a more recent development with the downward aggressive selling in things like PayPal and Square.
Yeah, and I think one thing that really stood out to me in early November was the weakness in something like PayPal. It's the biggest fintech, one of the biggest fintechs out there. And this thing really started breaking down in early November, and it was one of the first ones to gap down. And then we have a couple other fintechs. There's also Coinbase, Upstart, MQ, AFRM. These are some FinTwit darlings that also have completely been crushed.
Yeah, and so when that's a great point to bring up when you talk about November of last year, because when you just look at something like PayPal versus the S&P, that's a pretty major breakdown in November. So the recent selling that we're seeing in some of these names shouldn't really be a surprise if we're using a process where we're comparing it versus the S&P or something else to give us some clues on what are buyers and sellers doing here. The recent selling is not really new. This goes back months, all the way back to November. Is that a fair assessment?
For sure. The warning signs have been here for a while now.
Right. So this isn't like a shock to people. And I think that now this isn't fintech, but I think that falls in the same category with like Meta with or Facebook, whatever you want to call it, right? Today being the day after Facebook gets sold pretty hard in the overnight session after earnings release. That also isn't new information, because when we look at Facebook both on an absolute and a relative, that's something that falls off. Thinking about another, major company like Facebook like that's in the tech space, Google, some big announcement this week, guys.
Yeah, the split 20 for 1. They finally did it.
Yes, they finally did it. Yes. So walk us through that, Ian, when you say that they finally did it. Why 20 for 1? Why is that a big deal?
Well, I mean, I guess Google, Amazon, probably the two stocks that people, I don't know the best way to phrase this, people want there to be a stock split so they don't have to pay 4 digits a share. I can't, whatever Amazon's at now, somewhere around $2,800. So Google did a 20 for 1, which means that you're going to get 20 shares for every 1 share that you currently own. And obviously, that sounds amazing. It's not free money. They do cut the shares then by in 1/20th. So
if they did it today, you're saying that, with Google sitting at approximately, I'm going to use a round number, $2,900, that you're going to, per share, that price is going to be around 145 if they were to do it today. Now, I believe it's supposed to happen in July, but that's kind of a big deal for retail investors, right? It's a lot easier to put $145 in my teenager to go buy Google now than it was before at 2,900.
Mm-hmm.
And is it a good or bad thing for stocks? Do you guys have any history on this as far as splits?
I don't know. I mean, I would say it's mixed. I know it's happened. We've had a few big ones over the last few years.
Pratty, any newer or more recent splits that you could think of?
Yeah. And I guess one thing to mention before I talk about the splits is that it's important to realize the context that the splits were happening in, whether we're in a bull market or whether the stocks were really extended. So, for example, if we think back to summer of 2020, Apple announced a split at the end of July. And that split ended up happening, I believe, on September 1st. And at the time, Apple was about 60% above its 200-day EMA. And this split actually ended up marking a high in Apple on an intermediate term. And on a relative basis, Apple has been unchanged until just last week. So you could have owned Apple or the S&P and it wouldn't have mattered on a relative basis.
Since the split?
Yeah, since the split.
Wow. Okay. No, that's good info. Are there any others like that? I mean, that's pretty interesting. We're not saying that's what happened with Google in July, but it's a good find. It's a good notice that Apple on a relative basis kind of moving sideways here since that split.
Yeah. Another one is Tesla. Tesla was about 150% above its 200-day EMA when it split back in 2020. And it actually split at the same time as Apple. That also went on to mark I would say this was more of a correction through time than price, but a consolidation right after the split.
Yeah, for sure.
Okay. And Netflix, I know those weren't. Netflix is what? Split twice.
Okay.
Yeah, 2004. I mean, right into basically the top. I mean, immediately went into a 76% drawdown afterwards.
Oh, really? In 2004, when Netflix split, it then began to.
Yeah, I mean, it was basically the day. I mean, it was at the top.
That's
and then 2015 split, July 2015, and near an intermediate top and didn't go anywhere for basically went sideways for almost a year.
Yeah, so
a year and a half.
So is it fair to say buyer beware? Now, maybe that's something always fair to say, but when something splits, it might not necessarily mean a tremendous opportunity. Is that now we're using what, 3 examples, 4 examples?
And there's been others like Reso, Microchip Technology, MCHP had a split recently in October, and that actually ended up marking a bot. I mean, that was on the day. It went up 28% over the next 2 months.
Okay.
So a decent one there. And then Intuitive Surgical was also a more recent one. And that ended up being like a short. I mean, it did rally for a few weeks after that, rallied like 14%, and that was October as well.
Very interesting.
Another example I can think of right off the top of my head is NVIDIA.
Yeah.
When that split happened, NVIDIA went on a great run after. So it's not like we're coming on here and saying that the split is going to be the top in Google. We don't know that. We're just looking at some of the past examples in history and what's happened.
No, that's a great way to put it.
Last July, and it's up. Yeah, went on an 80% run after that.
No, it's a great point, Pratty. Like, we should always be using price. So maybe it's buyer beware, but we don't know. We don't know until the split happens and then what price does afterwards. I do know from a sentiment perspective, it's always interesting to me when really large companies decide to split like their stock price or their shares like this, only because it does make it easier for retail. And so the critical thinker in me says, well, okay, that's also a great opportunity for institutions to sell into. Now we'll see if that happens. We'll know through price.
NVIDIA 2006 split, and then about 2 weeks later, it entered a 45% drawdown.
Yeah.
So I don't know if I think it goes back to, so NVIDIA, let's talk. So NVIDIA also split September 2000. That was followed by a 68% drawdown. NVIDIA split again October 2001. And that led to a 202% rally.
There you go.
So, I mean, I think it goes back to, I don't think there's
a hard and fast rule.
I think there's definitely some sentiment there, and it just depends on whatever mood investors are in at the time.
Right.
I mean, what is different between NVIDIA splitting? They do a 2-for-1 and then another 2-for-1 14 months later, and they have completely different reactions. And so that was so semiconductors stayed pretty kind of strong after .com bubble.
Yeah,
many NVIDIA did. And
at least, there were spots within this. That was definitely a transitional period for semiconductors during the .com bust there, because there definitely were semiconductors that didn't have necessarily the same downward corrective move that we saw across the, semiconductors as a whole.
When I think Pratty brought up the Qualcomm splits, right? So Qualcomm splits May 99, a 2-for-1, December 99, a 4-for-1. So, right. So the 4-for-1, I mean, the top, Qualcomm goes down 88% over the next 3 years. But you've got, I mean, May 99, it goes up 775%. So,
right. No, and it makes it's really interesting because you're right. You're right. Since January 2000, the other thing that's fascinating about Qualcomm, just looking at it from that big picture perspective, is it did have that correction, but it also went nowhere from January 2000 until July of 2020. So that thing has moved nowhere since that split. Now, again, I'm not saying that that's what happens with all splits, but it is fascinating when these things could potentially be marking important turning points. Yeah. And so you just got to be aware. You got to be aware of that situation, that yes, that makes it quote unquote cheaper to buy for the average retail investor. And that's both great, but also something to be aware of from a sentiment perspective that institutions can sell into. And we just have to use price. We have to use price levels to manage that risk. So we'll see what July brings. Who knows? Maybe the market's correcting into July and the Google split marks a significant bottom in July that we higher, kind of like NVIDIA did at one point. So great stuff, guys. Fun to talk about these things. So Pratty, thanks for joining us during this part of the podcast to talk over these things. Great work. We appreciate it.
Yeah. Thanks for having me on.
Thanks, Pratty.
Well, that was pretty awesome to cover with Pratty. He provides a lot of good insights, whether it's pickup lines or positions or whatever you name it. We've reached the end of our time for this podcast. Hope you guys appreciate it. Ian, anything else you want to highlight or just paint the picture for before we sign off for the week?
No, I mean, I continue to think we see lower highs and lower lows in most charts. I'm not going to get into Elliott waves and all that, but I think that there is potentially at least one more pretty gnarly low to make in most equity assets in the coming months.
Totally get it.
We'll see. I mean, I'm totally willing to be
These are all
wrong.
theses,
we get back
right?
up above, get back above 45, 50 and hold it, right? Because we were there Wednesday and couldn't stick it. And to me, that just says lethargic market and people aren't serious about owning stocks. Maybe it's just a choppy uptrend. Totally willing to accept that as well.
We could chop, and that would eat a lot of people up. And we'll see. We'll always use price. That is our main factor. That is what we're going to look at to manage risk versus reward. And if we're below certain levels, we don't need to participate. No problem there. Ian, as always, thank you for your insights. Much appreciated. And all those listening, we appreciate it. We'll talk to you guys again in a week.
Have a great weekend, everyone.